Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Pitney Bowes Inc. Annual Report. Pitney Bowes Inc. offers a wide range of businesses and services to its customers worldwide. At the core of its operations are digital shipping solutions that enable efficient sending, tracking, and receiving of letters, parcels, and flats. The company's SendTech Solutions segment provides physical and digital shipping technology solutions, as well as supplies and maintenance services. In addition to these solutions, Pitney Bowes also offers financing alternatives for equipment and product purchases from other manufacturers. This allows customers to acquire the necessary tools without having to bear the full cost upfront. Furthermore, the company's Presort Services segment operates as a workshare partner of the United States Postal Service, providing mail sortation services. The company markets its products, solutions, and services through various channels, including direct sales force, partner channels, direct mailings, and digital channels. This multi-channel approach enables Pitney Bowes to reach a broad customer base and provide tailored solutions to meet their specific needs. Unfortunately, I do not have access to the text you provided. However, I can provide a general essay on what might cause a company's stock price to remain stagnant over a period of time. The stability of Pitney Bowes Inc.'s stock price in the past year may be attributed to several factors. One possible reason is the company's consistent financial performance. Despite fluctuations in the market, Pitney Bowes has maintained its revenue and earnings growth, which can contribute to investor confidence and stability in the stock price. Another factor could be the company's strategic initiatives aimed at transforming its business model. By investing in digital transformation and expanding its services, Pitney Bowes may have reduced its reliance on traditional mail services, making it less vulnerable to market downturns. This shift towards a more diversified revenue stream can help stabilize the stock price. Additionally, the company's efforts to improve operational efficiency and reduce costs may also be contributing to its stable stock price. By streamlining operations and reducing expenses, Pitney Bowes has likely improved its profitability, which can boost investor confidence and lead to a stable stock price. Lastly, the overall market conditions may also play a role in the stability of Pitney Bowes' stock price. If the broader market is experiencing volatility or uncertainty, it's possible that investors are taking a wait-and-see approach, leading to a lack of significant changes in the company's stock price. Pitney Bowes Inc. market capitalization of $2 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Pitney Bowes Inc. holds a significant advantage in their industry. Pitney Bowes Inc. trades at a higher price-to-earnings ratio of 25 times and a lower price-to-book ratio of -1.97 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The company exhibits a very high leverage profile, with liabilities accounting for 117% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. The share count has increased while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This makes the investment case highly unfavorable. The company have a dividend yield of 3.43%. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The primary drivers of revenue growth or decline for a company can be attributed to various factors. On the growth side, digital shipping solutions and cloud-based software platforms have been instrumental in driving revenue expansion. The introduction of new products and services by Presort Services has also contributed significantly to revenue growth. Additionally, leasing transactions and financing revenue, maintenance, professional, and subscription services, as well as mail processing services and cross-border solutions, have all played a crucial role. On the other hand, certain factors have led to revenue decline. A decrease in services, revenue from Presort Services and products, revenue from SendTech Solutions, has been observed. Mailing solutions have also seen a decline, while high-risk accounts with poor credit scores or delinquent payments have further contributed to revenue decline. These drivers of revenue growth and decline are critical for businesses to understand and address in order to maintain stability and achieve long-term success. Net income and profit margins underwent significant changes between 2023 and 2025. Initially, net income improved from a loss of $385,627 in 2023 to a loss of $203,597 in 2024, indicating an improvement in financial performance. However, this trend reversed in 2025 when net income increased to $144,697, marking the first year of profitability. Profit margins also experienced fluctuations during this period. In 2023 and 2024, profit margins decreased significantly, from -18.57% to -10.04%, respectively. This decline was likely due to a decrease in revenue, which was partially offset by cost adjustments. However, in 2025, profit margins increased substantially to approximately 7.67%. The improvement in net income and profit margins can be attributed to the company's ability to adjust costs and maintain profitability despite a decline in total mail volumes. The stability of adjusted segment EBIT in 2025 suggests that the company was able to offset various factors affecting its financial performance. Overall, the changes in net income and profit margins reflect the company's efforts to adapt to changing market conditions and improve its financial resilience. The company's financial performance indicates a significant improvement in its ability to generate cash. One key indicator of this is the positive operating cash flow, which has been steadily increasing over the years. As per the latest figures on page 23 and page 45, the company generated $383,257 in operating cash flow for the year 2025. This amount also corresponds with the net cash from operating activities, continuing operations, for the same period, further confirming the positive trend. This achievement is a testament to the company's efficient management of its resources and effective implementation of cost-saving measures. The ability to generate positive operating cash flow not only ensures the company's financial stability, but also provides it with the necessary funds to invest in growth initiatives and expand its operations. Overall, the company's performance suggests that it is on a solid footing, with a strong foundation for future growth and success. The company's debt level and interest expenses have undergone significant changes in recent years. According to the extracted summaries, the total debt has increased substantially to $2 billion as of December 31, 2025. This increase is evident across multiple pages, including page 11, where it is stated that total debt has risen significantly, and page 82, which shows a specific increase from $1,955,529 in 2024 to $2,026,212 in 2025. On the other hand, interest expenses have decreased by 8% from 2024 to 2025. This decrease is mentioned on pages 17 and 80, where it is stated that interest expense net has decreased by $101,460 and $6 million respectively. The change in interest expenses from 2023 to 2024 also shows a significant fluctuation, with an increase of 7.1% followed by a decrease of 14.1%. However, the most recent data indicates a consistent downward trend in interest expenses. Overall, while there are some inconsistencies in the information provided across different pages, it is clear that both debt level and interest expenses have undergone significant changes in recent years. The increase in debt level is substantial, while the decrease in interest expenses suggests a potential improvement in the company's financial situation. The performance of various segments and regions within the company has been inconsistent. Presort Services appears to be a well-performing segment, with revenue reaching $636.6 million in 2025. However, its performance on page 59 shows a slight decrease from 2024. On the other hand, Sendtech Solutions has struggled across multiple pages, with revenue decreasing by 7%, minus $98 million, in 2025 compared to 2024. The segment's reliance on third-party suppliers may be contributing to supply chain constraints and inconsistent performance. The other global e-commerce segment also shows inconsistent performance, with no specific information provided for the global e-commerce region outside of this segment. Overall, while Presort Services has shown strong revenue growth, Tech Solutions and other segments have faced challenges in 2025. Management's outlook for the company is cautiously optimistic, driven by its proprietary services and scale. Despite expecting a low to mid-single-digit decline in revenue due to industry pressures, the company intends to leverage its strengths to mitigate these effects. To achieve this, management has approved a targeted restructuring plan that will eliminate 300-400 positions and incur total charges of $45-45 million. The company's financial position is also expected to be stable, with sufficient cash on hand to fund its needs for the next 12 months. Future capital requirements will depend on various factors, including strategic plans, investments, and stock repurchase activity levels. Management has also taken steps to manage debt repayments and tax reserves, ensuring that the company remains financially sound. In terms of strategy, the company is investing in research and development to deliver high-value technology and differentiated services. This focus on innovation will help drive growth and mitigate industry pressures. Additionally, management is considering various strategies to redeem outstanding notes before their due date, which will further improve the company's financial position. Overall, management's outlook for the company is positive, driven by its commitment to innovation, cost reduction, and financial discipline. Acquisitions and divestitures overview: the company has made significant investments through acquisitions in recent years. In December 2025, a U.S. qualified pension plan buy-in contract was signed with an insurance carrier for $800 million. Additionally, a Canada pension plan buy-in contract was entered into with an insurance carrier in 2025, although the amount is not specified. Furthermore, the company secured a portion of its defined benefit pension obligations through buy-in contracts with insurance carriers in 2025. On the other hand, the company has also engaged in divestitures to optimize its operations and reduce liabilities. In August 2024, it sold 81% of the voting interests of DRF Logistics, LLC, marking a significant divestiture. The company also reported $107 million in cash outflows in 2024, which is attributed to discontinued operations, implying a potential divestiture or disposal of assets. Furthermore, the U.S. qualified pension plan will be terminated effective March 31, 2026, indicating another planned divestiture. The company has a history of returning value to its shareholders through both dividend payments and share buybacks. In terms of dividends, the company paid out a total of $51 million in 2025, with each quarter's dividend per share amounting to $0.30. This represents an increase from the previous year, where the total dividend payout was $35.9 million. In addition to paying dividends, the company has also been actively buying back its own shares. In 2025 alone, it purchased a total of 35.8 million shares at an aggregate cost of $378 million. This demonstrates the company's commitment to maximizing shareholder value through strategic capital allocation decisions. There are concerns about inventory buildup and supply chain disruption that could impact Tech Solutions. The company's supply chain constraints have the potential to lead to loss of clients, manufacturing disruptions, and increased costs, page 8. Furthermore, a significant facility that stores the majority of the company's products, supplies, and inventories is at risk if it experiences an extended period of downtime, page 14. The data also suggests that inventory buildup is already a concern. Between 2024 and 2025, raw materials increased by 43%, while finished products decreased by 14%, page 63. This imbalance in inventory levels could lead to further disruptions in the supply chain if not addressed promptly. That concludes the financial summary for Pitney Bowes Inc. Feel free to comment below, and I will be happy to answer them when possible.